All right, folks, I think it is time. Close this. Well, good afternoon. I want to thank everybody for taking time out of their busy days here on a Friday afternoon and St. Paddy's Day to join us to talk about what is clearly a very timely issue, which is both what recently happened with Silicon Valley Bank, some of the issues that occurred, and we're going to walk through really an agenda, introduce our panelists. We have an esteemed panelists of bankers, all that have a slightly different perspective on the market, which is why we've assembled them. They've also been historically great partners for us, this region, Ben Franklin and the startup community. And I will ask them to introduce themselves here in a moment. Then I will talk a little bit about, from my perspective, and I want to be clear, this is not the perspective of the state, Ben Franklin, or any of the panelists. This is Scott Nissenbaum's opinion around what happened in SVB and maybe some of the issues. We'll then talk broadly about where we go from here, what it could mean for your business, how we're looking at it as an organization, and then if you do decide that there are other options or issues that you need to address, you have both a panel of experts and resources for us to help you. Please keep in mind this is being recorded, so if that is a problem, you'll need to log off now, and that this is for the private use of our portfolio companies here in Ben Franklin, and as an invite-only expression. So it is private. With that, again, if you don't know me, my name is Scott Nissenbaum. I am the president and CEO of Ben Franklin Technology Partners in Philadelphia. I have been both a VC, a venture-backed entrepreneur, a banker to VCs, a debt lender to VCs, pretty much any way that you can be involved in an early stage tech company, I've done it. Joining me now are three esteemed individuals in the banking industry. I'm going to go one by one here, but Lou, I'm going to ask you to kick it off. Lou Lombardi from Fulton Bank.
Great. Thanks, Scott. Great to be everybody this afternoon. Pleasure to be alongside my colleagues from WSFS and PacWest. So great to be with you. Lou Lombardi, Regional Commercial Executive for Fulton Bank. I'll give you a little bit of background on Fulton and how we got into life sciences and tech. I think it's obviously relevant. Founded 140 years ago, headquartered in Lancaster, Pennsylvania, grown to 5 states over the years. Today we're $26 billion in assets, full service, commercial, consumer, and wealth practice. About 6 years ago, we were expanding into urban markets in Philadelphia, New Jersey, Baltimore, DC. Looked around, realized there's a lot of life sciences and tech going on, and we always had a focus on small business, but we really didn't know early stage life sciences and tech. And obviously their needs are unique. So we developed a strategy to support earlier stage life sciences and tech companies, realized that we had to hire a subject matter expert or two, because we really wanted to make sure we understood the unique challenges and opportunities those companies faced. We have 3,500 employees that know banking, but we needed subject matter experts. So we hired a couple of folks, one from the Baltimore area with higher ed, Johns Hopkins, transfer tech kind of background. And then we also hired somebody with a PhD in organic chemistry to cover the Philadelphia market. And he also has 14 years at Ben Franklin. So obviously a lot of good experience there. We also developed a separate credit policy that allowed us to lend to earlier stage life sciences and tech companies. We've invested in a few funds, and we're opening an office in University City. So that's just a little bit of background on myself and Fulton.
Thanks, Lou. And then next, Jim, let's jump to you.
Thanks, Scott. Good to be with everybody. Happy St. Patrick's Day. Jim Gise. I run the middle market syndications and capital markets businesses for WSFS, which is a community bank located in Wilmington, Delaware, about 21 billion in assets, been around for 190 plus years for most of that time as a passbook savings and mortgage company, but within the last 25 or 30 years build out a full-blown commercial platform. We do have a very nice wealth business bolstered recently by our acquisition last year of the Bryn Mawr Trust Company. So we, unlike what Lou outlined for Fulton, we do not have a vertical specifically for the the VC or tech community. And we frankly don't have many verticals per se, but we do have interest in the space. As Scott said, we do find different ways to support the community. We bank one of the Ben Franklin Technology Partners operating companies. We have we do bank a PE firm whose business it is to invest in VCs. And we do have a healthcare vertical, not life sciences yet, but more on the senior housing and hospitals, so provider side of the equation. I'll just finally mention on us that we do have some interesting, we don't make direct equity investments into VC angel-owned companies as a general statement, but we do have equity positions in a couple of interesting fintechs, Spring EQ and Cred AI or two, and we have made others from which we have exited successfully. So thanks, Scott.
Thanks, Jim. And last and certainly not least, Elizabeth Orsinger with PacWest.
Thanks. Hello. Good afternoon. Thanks, Scott. A little bit on myself. I'm based in DC. I'm a senior banker leading our originations team with our venture group. So PacWest is a $40 billion bank based in LA. We have offices across the country and any tech hub. Our venture division is about 12 billion in assets under management. And we've been lending to the startup ecosystem since 2005. So that's really early stage companies, kind of seed. Series A tends to be the first inflection point in terms of debt financing to an exit, which tends to be an M&A transition, but sitting squarely focused in the venture space, meaning that as companies continue to grow, become cash flow positive, EBITDA, break even, and probably more greater appetite for private equity firms, that tends to be where we exit. So we're lending anywhere from $1 million to $75 million to these companies, as well as just a general array of cash management strategy and depository services.
Got it. All right. Well, appreciate the background, each of you, and I think you'll see as you talk to them that they all have a little different perspective, and their bank, sort of addresses and sort of goes after this market a little differently. So we should get some good conversation going here. Before we dig into some Q&A, we have about 45 minutes. I want to make this as interactive as possible. So I'm going to start off with, at least from my standpoint, we did a pretty in-depth assessment of sort of what happened with Silicon Valley Bank. So I'm going to try to recap that again as my opinion of what occurred, the strengths, the weaknesses, the bad, the up, the down. Please do feel free to ask questions during that. You can either raise your hand or frankly just take yourself off mute and interrupt. And then we'll get into it and talk a little bit about it as a panel, and then we'll save probably 15 minutes at the end for Q&A. And so how many of you banked at SVB before this? All right, so we have one or two. And so I will tell you that when Silicon Valley Bank announced the issue and the collapse and the takeover, I spent a fair amount of time going through and digging into their legal filings, their 10Ks, their 10Qs, their 8Ks, and really looked at what was going on in the market. And as a quick background, I did do late stage venture debt for Hercules Technology Growth Capital. So I sat in the SVB seat in a number of different ways. And genuinely a bank like that lends as an equity to debt ratio. And what I mean by that is if VCs come in with $4, a bank like Silicon Valley Bank will lend into that round at the same time $1. With the idea being that their dollar with $4 other dollars at risk after theirs will not allow the company to go under with just the debt. It's got to be a systematic issue for them to lose money, because the VCs would have to lose all of their money before the bank loses a penny. Which means that if Silicon Valley Bank were to have the type of collapse that I think the market looked at SVB, it would really could be a fundamental issue with the relationship in the VC market and private equity of overpriced things, not enough dollars and things going under. I can tell you from my standpoint, that is not what happened. That is not even close what happened. If you read their 10K, which is publicly available, they brought in 3 times more deposits from 2019 to 2023 when this occurred than they had historically had. It was all-time deposit highs. And as a consequence of that, they had to find a place to store that cash. And I will tell you, as someone who has the vision and the guidance of being a Monday morning quarterback, they put that money into medium-term duration bonds, which gave them a locked-in rate of return at under 2%. When interest rates started to skyrocket and that the private, the markets were now yielding 4, 5, and 6%, they were losing money. And if you don't follow bonds, there's an inverse relationship to price and interest rate. And so those bond values fell. And so what they said was, we can sell these bonds today. That was $21 billion worth of bonds. We take a $1.8 billion loss on those bonds, and then we can reinvest those dollars in higher yield. And we will, and this is in the 10Q, this is in the AK, we will increase our net interest income each year by $450 million. So we take the $1.8 million loss today, we increase it 450. Yes, it stinks that we did this, but it's not a big deal. Then there was an unrelated entity bank called Silvergate that was tied up into and had serious issues with FTC, which was the crypto markets that invested all of their crypto into their own cryptocurrency. Don't get me started on that one. I'm pretty sure that's genuinely illegal. And so they were associated, guilt by association, even though the only thing that was Silvergate went under about the time people were talking about Silicon Valley going under, but the market didn't dig in to really answer the question. And so the takeaway that I had from this was, this is about an interest rate mistake going short-term versus long-term because of the rise in interest rates. It wasn't because their portfolio was failing. It wasn't because they made bad loans. It wasn't because the sky was falling on private equity and VC. They then doubled down on their colossal mistake by basically having the CEO get up there and tell the markets, I know you guys are panicked, but just calm down. And so you can imagine what the market did. I would also argue, as I understand it, and I have not identified the four, there were 4 major players, including Peter Thiel, in Silicon Valley that told their portfolio companies, 50 or so of them, to pull money out of the bank. And if you look at the implications of a couple of big VCs telling dozens and dozens of companies all at once to get their money the hell out of the bank, it created the panic. It made the run on the bank. And then it became a self-reinforcing cycle that basically blew up on Silicon Valley Bank, which is a damn shame, given that, frankly, they did a really nice job for the community and the engagement. Having said that, there were fundamental problems with SVB's business, not the least of which was concentration. You can't have a run on the bank through a couple of VCs if you don't have most of your money from a concentration in a specific sector, in this case, tech, right? The communications plan that they used was piss poor. They were not out ahead of it. Their 8K did a good job explaining it. Their press release, which says we need liquidity, so we sold $21 billion of bonds at a $2 billion loss. Clearly not the message that was enough to reassure the market. And then bad timing. Right? Bad timing in that everyone's a little panicked right now with the rise in interest rates, the fear of recession, war in Ukraine, and then just panic ensued, along with the Silvergate guilt by association, even though there was no association. So from my standpoint, we don't have a fundamental issue, but we did have a bank takeover. And that is where Silicon Valley Bank sits today. As you know, FDI insurance insures up to $250,000. FDI insurance, if you don't remember, was created during the Great Depression to protect $500 worth of deposit individuals. It was never meant as a business protection. And we're going to talk a little bit about now, given that the cap is still $250,000, and unless you want to rely every time a run on the bank occurs, that the federal government's going to bail them out, there are ways to protect yourself. So let me take a breath, because I spewed a lot of data at you on SVB. And as I'm about to open it up to the conversation to the panelists, but are there questions on that, just as a background of history? Cool. Okay, well, then let's kick it off. An opportunity for the panelists, and anybody can jump in here about my comments on SVB and any comments that you think you'd like to make, something you see differently, or something you just want to refine that I think makes it a little clearer and a little bit understood by everybody.
Scott, I would just add, first of all, I thought your explanation was excellent. One thing we found interesting was that, as bad as it was for the concentration in deposits, and I'll say poor blocking and tackling and asset liability management, last week's moves to sell securities and borrow short term was not inherently bad. It was okay. It's like normal CFO, stuff, just like the other guilt by association, Silvergate things that you mentioned. But yeah, I just wanted to throw that in.
Yeah.
Yeah, and if I could jump in again, Scott, you summarized it well. Just to say it in one word, or two words, lack of diversification. I guess that's three words, lack of diversification. Yeah, across the spectrum, their deposit base, their industries that they serve, really just in every respect. It's interesting when you look at the banking industry, you've got over 4,000 banks across the country. And there's a lot of talk right now. It's mostly focused on regional banks. And just to put that in perspective, when you look at regional banks, you're probably talking about, it's less than 100, probably about 100 banks. So of those 4,000, the focus is on, these 100. And just up until 8 or 9 days ago, there were no concerns with the state of the regional banking industry in this country. Regulatory requirements for capital reserves, oversight of the banking industry has never been stronger. So it's really interesting that just, a couple of things can kind of throw things askew. I would say that when you look at Silicon Valley Bank, and this word is being used out there, and Signature as well, I would categorize them as an outlier relative to the other regional banks, just in how they were built, constructed, the concentrations they had. So when you look at the regional banks, there's a lot of diversification. And I'm talking about with, WSFS and PacWest. I mean, there's more diversification amongst the vast majority of regional banks. You're really talking about just a handful that were focused in a very narrow basket, very tall, but very narrow basket. And that's really where I think the concerns probably should be. But I think the regional banking industry as a whole is pretty solid. I'm not a bank analyst, but that's just my perspective on things.
Elizabeth, anything when you want to add?
Yeah, I know, I'd agree with all that. I mean, you guys hit the nail right on the head. I mean, and recent news, I think various news outlets and papers or medias are trying to also politicize the situation, and it's really not. It's really just the economics of it. What SVB did was not necessarily wrong, as Jim mentioned, in terms of how you invest in offshore deposits to right size a bank's balance sheet, but the timing was poorly. I mean, everyone knew interest rates were going up and they were going to go up sharply. There was no that was not being hidden by the Fed.
Yep. And I will say, one thing I didn't comment on was the change in the last administration's policy on the reserve ratios within banks. That did play into this. But again, I didn't even include it in there because frankly, it wasn't the cause and it wouldn't have changed the outcome, in my opinion. So we can talk a little bit about lessons learned, but I think for a lot of people on the call right now, the concept of $250,000 insurance, if you have $2 million in the bank, dividing that across 10 banks sounds ludicrous. So from the panelist standpoint, how does an institution that is above the FDIC limit have a relationship with your bank or any bank and continue to feel comfortable that this type of issue won't happen for whatever reason? Is there ways to protection? Is there insurance? Is there or do you just divide it across 10 banks?
Scott, yeah, the great question, and frankly, one that our conversation with mostly our biggest depositors, which we did on a proactive basis, and obviously lots of concentration with clients. So there is this is not a WSFS product, but it is available through banks in general, called CDARS. CDARS stands for Certificates of Deposit Account Registry Service. And essentially it does for folks, Scott, what you just outlined. So to take, $2.5 million and spread it over in a way that's, no muss, no fuss for the client over 10 different banks, do all of the statement processing and essentially achieve what you just said in kind of a systematic way. So that's one thing that has been a topic of conversation this week.
And it's a CDASR?
CDARS. So CDARS. Yeah.
Got it. All right. Thank you. Appreciate that. Other options?
Can I?
Yep, go please. Yes.
Go ahead, Elizabeth.
Yeah, similarly, just to expand on that, there's a couple of different vehicles in which do that. There's an insured cash sweep. There's a money market fund as well. effectively what it's doing is anything above 250,000 stays in your bank account, that's FDIC insured, and the delta is swept overnight to a network of banks, effectively like overnight investing, and then swept back to the account and then swept again. And so you're earning a slightly higher yield, but in that way you can break up that bulk funds and get by pieces that actually insured up to, I believe it's 150 million for one account.
So the natural, and Lou, sorry, do you want to add something?
Well, I was just going to tie in, a lesson learned into your question. You should have a relationship manager with your bank. You should have somebody assigned to your relationship who is proactively reaching out to you. Jim mentioned that. If you don't have that, then I would, ask you to reconsider and interview some of the folks on this call or some other banks. But you should have a relationship manager that's recommending things to you. And like Elizabeth and Jim said, there's plenty of services to mitigate your risk without having to complicate your banking relationship. I don't think you want to have 6 different banks that you deal with because you have money parked all over the place. To try to run a business like that with operating cash flow needs day to day, moving money here and there, sounds very complicated to me. And quite frankly, it's just not necessary. So you should have a relationship manager. That's a lesson learned, I hope, for all business owners. And they should be, the services are out there. Almost all the banks have it. You can protect your money and not complicate your life.
So here's a question we didn't talk about, but now that you guys are sharing, why didn't these instruments protect Silicon Valley Bank and the depositors there?
I don't, Jim, you want me to start and then you can
Go
jump
ahead,
in
Lou.
there? I don't think anybody anticipated a run happening this way. I mean, go back to prior bank runs. When was the last one? How long did it take? In today's digital age, people moving money, it happens instantaneously without picking up a phone and having a chance to talk to a banker to say, hey, calm down, like everything's okay, just relax. So I think there just wasn't the thinking that, what were they, $200 billion bank could go under that quickly. So I think everybody, honestly, I think a lot of people would have been caught flat-footed on a bank run. I mean, I don't think anybody was really ready for that. But I think it is the job of the banker to go out and make these recommendations today. We can't go back and look at it in the past, but from this point forward, all banks should be talking to their clients about these things.
And Scott, if it's okay, might betray my my libertarian leanings here a little bit, but to some extent, this is a little bit on the depositors to sort of diligence these are institutional investors. They should know that there's a limit to FDIC. They should be, sort of doing some diligence on where their money is and how it's protected. And I, look at, as Lou said, the bank run was done on swipes of a phone. It was a lot different than what we've seen and quicker and fed by social media. But at the end of the day, these are really smart institutional investors that could have done more to protect themselves. And I should say that's not necessarily the WSFS party line, but that's my personal perspective.
Got it. Appreciate it. I would love to see if any of the original VCs that helped facilitate this issue sold their Silicon Valley stock. Because I do think that would be the definition of collusion. As someone who carefully tracked the GameStop issue, and that's, again, a Scott Nissenbaum opinion, but I would be intrigued to know. Okay, so any other lessons learned, at least from your perspective of from this? I mean, for me, the clear lesson is you got to pay attention. Right? What used to be a, like, you just set it and forget it kind of attitude. Now, between the change in interest rates and the regulatory environment, and the volatility of movement in today's market, you got to be on top of these things. That goes for the banks that are buying interest rates and mortgages. That goes for communications. When you say something, you got to be clear so that people don't misinterpret. Or, and I'll say it another way, you got to make it so clear and beat them over the head with it that they hear you. rather than an off the cuff, no panic kind of message, because clearly that couldn't work. Those are my lessons, learned from this.
Scott,
Others?
can I jump in on one more topic there? Obviously, founders are super busy. I mean, they're trying to recruit, hire, build a business, create value. They've got so many things that they're focused on. I understand why, banking is, you kind of assume that things are going to work and they're going to be there when you need it. But obviously, we've learned that selecting a partner, it's worth the time and energy to make sure that you've got the right partner long-term. And not just so that things work smoothly, but that you got a partner that's going to help you achieve all those goals and objectives that you have. And there are good options out there. So, certainly any of the three of us here, but there's other banks out there as well. It's worth the time and energy to really sit down, meet with these organizations, make sure they're the right fit for what you're looking to achieve over the next several years.
Yeah, and I'll just kind of just piggyback on that with, why didn't SVB push these products? I mean, you're going to get into the weeds of how that cash was being moved, whether it was on their balance sheet or off their balance sheet, which we don't need to go into the details of that, but it certainly plays into the economics. And as Lou was mentioning, being with a regional bank, for instance, it's a smaller pool of clients, and therefore you can have that intimate conversation where there's someone is at the bank proactively helping you and reaching out to you. But as you go to, the JP Morgans of the world, right? And maybe you have a couple, maybe just even a couple $1 million. You're small potatoes. They've got bigger fish to deal with. And so you're less of a concern, quite frankly, for them to have that outreach or to think about, what is this $1 million account here? That's, pretty much nothing to them. And so I think similarly that aligned with SVB too, especially if you think of these tech companies, life science companies that are raising, tens of millions, hundreds of millions of dollars, for folks that have maybe even just a couple million, just not even hitting the radar.
So does this change the way banks interact with the tech community? When I say tech, I do mean tech and life sciences, the venture-backed portfolios, the venture community. Is this going to raise lower standards? Is this going to differentiate how you look at them?
I mean, for my world, this is, certainly we plan to continue to work in this space, probably even more so, just given there's an exit of a player. But it's not to be kind of a white knight, so to speak, for folks that were SVB. I think is still sticking to our knitting and type of profile of clients that we're looking for.
And if you don't mind, go ahead, Lou.
Well, I was just going to agree with what Elizabeth just said. Banks have a strategy. They know the target client that they're going after. They know where they can fill a void. I can't imagine one situation is going to cause them to pull back. Over time, would some institutions that have a heavy concentration in that maybe get a little bit tighter here and there? I guess that's possible. We're looking at it as an opportunity as well. We're proactively reaching out. So we look at it as a growth opportunity for us, not to prey on, SVB clients, but the reality is they need a bank that's going to be there for them. They have a lot going on. They need a banking partner. So we're trying to reach out to see how we can help.
Yeah, and I'll just add that we are at WSFS less of a specific vertical than Lou or Elizabeth, but broadly speaking, we view kind of times of turmoil as opportunity, because we know that the bigger, I'll say, nationally managed competitors will sort of make decisions to sort of pull back and look inward. Those are some of our best clients are folks experiencing turmoil at bigger banks and turn to us because we just don't make decisions that way. It's not that the bigger banks, are dumb. You just have to manage your business that way when you're that big. So just generally speaking, we don't anticipate this being any different in that respect. We think that we'll be have an opportunity to pick up some clients.
Got it. I appreciate that. So, Silicon Valley Bank really would underwrite against the VCs that back them, right? If you got an Andreessen Horowitz or a Kleiner Perkins in there, they'll bank you pretty much sight unseen. Has that attitude for you? I'm not talking SVB here, but for you, was that ever your philosophy? And has that not changed? And I know, Elizabeth, don't want to put you on the spot here, but you're probably the closest to what a Silicon Valley bank looks like from the outside world. Has that changed your perspective a little? Is it still the golden seal of approval that it used to be?
For the most part, it definitely continues to, look at to see who's taking the equity risk versus us taking the debt risk and how they're going to stand behind their clients. I think that certainly will be telling to see like an Andreessen, kind of household venture name who pretty much pushed majority of their clients to bank at SVB. So I think there's going to perhaps be a bit of an awakening of what is maybe more true to value underwriting versus just, SVB was writing really large checks with very little due diligence. So I think more so perhaps while our due diligence won't change, I think on the flip side, I think investors are going to wake up to a different reality of what real underwriting looks like.
Yeah.
Go ahead, Lou.
Well said, Elizabeth. At Fulton, we really haven't ever followed venture capital and then just blindly kind of went into a deal with it. We really do look at every customer on its own standing, certainly within the context of an industry, but certainly looking at every single company on its own under its own merit. And that's how most banks would underwrite any type of deal. We participate with other banks all the time. We buy their participations, they buy ours. Everybody still does their own due diligence, or at least they should be doing their own due diligence on every situation. We don't plan on changing our philosophy. We always look at every situation on its own.
Thank you. So there are a couple questions from the audience, one of which is around Brex, BREX. And for those of you in the audience, brex.com. It is in the the meeting chat. The comparison of those to the CDARS and some of the other sweep accounts, is that a similar product, similar solution, or another way to accomplish the same thing? I'm not familiar with Brex, so I won't comment on it, but
I'm only familiar with it because I just Googled it while we're on here and not come across it. It looks like, frankly, a pretty slick program. One that maybe a conventional bank should be terrified of, but I don't know much about it. I do agree with Elizabeth on the CDARS. I saw her chatted response, and frankly, there is happy to share sort of the I guess the standard brochure, again, not a WSFS product, but the CDARS brochure it's kind of a quick 2-page Q&A. Happy to pass that, Scott, to you after the call.
got it. Appreciate that. So it does sound like on CDARS, it's not a fee thing, it's a service thing as part of the overall bank, and that some of the other products that work similarly. It's really a question of maximizing that in interest rate. And so for those in the audience with the more detailed questions here around liquidity and the way it works, I would encourage you, and contact information for everyone is available to connect and get some answers.
Yeah, Scott, just on Brex, I'm looking at it too for the first time. It looks like a platform where you can handle payment and disbursement and probably integrating with the accounting software of a company, if I'm looking at that right. At Fulton, we have products that work similar to this. I'm not seeing it as a management of liquidity, but maybe there's more to it. I wouldn't be able to know without digging into it a bit more.
So I was the one that generated. Oh, I'm sorry, Elizabeth.
Oh, okay. Brex is an institution. They actually just, I think last year, filed for their banking license, but effectively kind of started out, and same with Mercury, as a neobank. So kind of somewhat of a digital bank. So it's not necessarily an institution. And so folks just moving their money to Brex is just really just another bank, for lack of better words. Not an investment instrument.
Got it. Okay, so Ira asked a question that kind of follows up on some of the other questions that I was going to ask. But there's two parts to any relationship with a bank. There's what the portfolio company wants to get from the bank, and what the bank needs from the portfolio company to build that relationship. And Ira's question, it really stems from, if you're just taking a portfolio company's deposit, do you need to do the due diligence? I will tell you, having spent a little time at JP Morgan, not my favorite job, but the simple process of what they call AML KYC, which is the anti-money laundering and know your client regulations. You cannot onboard any customer until you can verify to the legal standard in the United States that that money is legal and clean, i.e. not drug money, not terrorist money, not somehow illicitly getting into the banking system. And so that's the number one thing that I would say when a bank says they're doing due diligence on their clients, it's to make sure that they're not, the source to move, drug money from overseas or terrorist dollars. That's certainly one. Other banks have additional and above that standards as the minimum requirements. But anyone who want to comment on, from your standpoint, what you look at from a client, not only in terms of the legal onboarding, but sort of what your, sort of target looks like?
Yeah, I'll comment on that, Scott. We adhere to very basic know thy customer sort of standards, and for the most part, we are gonna, we do have to do all the things that are legally required, but knowing who we're dealing with, and we're a community bank, so we aren't going to be taking in applications from Chicago and Boston. It's going to be the suburban Philly crowd most likely, and there's going to be some kind of a connection, and that's an important, frankly, part of how we do business, is making sure there's some sort of a personal connection somewhere, and have a really good understanding of how the account will be used, even if it's just a deposit account.
Yeah, Jim's right. It's a combination of just, community banking, making sure you know who you're doing business with, but also regulatory things. There's, like Scott said, there are things that banks just cannot circumvent. We need to get certain information like driver's licenses and all of that just to open an account. So yeah, there's certain things. If the bank's saying they have to have it for regulatory reasons, I would guess that's probably accurate. When it comes to lending, there's a host of information that banks would want to collect and receive, just as any other investor in a company would expect to get.
There is a question from Tony Lasacci about why doesn't the Fed leverage this opportunity here to do a little better job in the liquidation or the turnover? And it's a great question, Tony. And I will tell you, when I saw SVB go under and hit $100 a share, I put in a buy order for SVB stocks on the off chance that they wowould allow me to jump in late, because it was because the fundamentals there beyond the bank run for the bank itself was yielding good income. It's silly to have an 80 or 90% drop in value. Unfortunately, they don't let me do that. The answer is it's not the Fed's job. The Fed is there as a savior rather than an opportune. And then you'd immediately have conflicts of, why is the federal government taking opportunity here versus private markets? Personally, I have a relationship with the gentleman who was heavily involved with the liquidation at Lehman Brothers and their real estate portfolio. He ran that for a turnaround firm. And they begged the Fed, pleaded with the Fed. They said, if you take it over, you're going to get our shareholders 20 cents on the dollar. If we take it over, we'll get 70 or 80 cents on the dollar. Don't do that. Let us do our job. And they did allow Lehman, and they did get a substantially more on average, at least that they would have claimed, amount back. And then when you talk about the guarantee above 250,000, that is a great question of, why not just increase the level on that, keeping in mind that the original FDI insurance was about individuals not being able to starve to death because their bank was lost to no default of their own. It wasn't designed as a business insurance. But clearly insurance products here and deposits and protections are something I think the whole Fed and the state and the banking community are going to be thinking about for sure. And I'm not sure if the insurance is higher, whether that will incentivize banks to take more risk, because the probability of failing those risks are still greatly outweigh the benefits, just because there's a little bit of insurance. It doesn't insure the bank from a bad loan. It insures the insurers from a bad bank. And I think that's a key takeaway here, right? It doesn't make it easier for the bank to take risk or extend risk or change risk. It literally just makes sure the depositors don't get stuck left, holding the bag if the bank fails to do their job. Okay, other questions from the audience? If not, I have a couple more. We're down to the last here, 15 minutes.
Scott,
Please.
would you post the contact information for Lou, Jim, and Elizabeth
Yep.
maybe after the meeting? It's a really simple question. We're at one of the too big to fail banks. They're not terribly helpful. We've been chasing this issue of treasury management for several years without getting satisfaction in terms of how to allay the risk for our investors' money, which we're stewards of. We had opened an account with SVB. We were days away from sending a trial deposit over, and this happened. And I will tell you that SVB was extraordinarily easy to work with for a biotech. And they were offering us 4.5% interest on our money. And of course, that we now learn they were earning 1.5%. So that's a recipe for disaster on their part. But I will tell you that we have not found other banks to be easy to work with. We have been looking for a cash management or treasury management solution for 3 years. So if Fulton, WSFS, and PacWest can help, there are probably hundreds of companies out there just like us who can't get, our banker with the too big to fail bank that we're with is down in North Carolina. The local banker is very, very nice, but clueless as far as biotech is concerned. So if you can provide us the kind of services we need, we'd be very interested. Now, why was everybody at SVB? Because we were a Y Combinator company, in addition to being a Ben Franklin company. And Y Combinator has relationships with SVB. I would say, I think over half the checks that came into us from investors came in from SVB. So that community is global. And there are probably, I don't know, I signed the letter from Y Combinator over the weekend, and we were one of those companies, but there are probably thousands of companies like us who have money that is not protected, that need a product. And so the CDARs and insured cash sweeps that you mentioned are interesting. And I think we need to find out more. All of your Ben Franklin companies need to find out more about what to do.
Appreciate that, Ira. I will say, and both in terms of disclosure and support, we have good working relationships with PacWest, with WSFS, and with Fulton. They wouldn't be on this call if I didn't feel comfortable that that you would be in good hands. That's not to say they're the only 3 banks in the world that you'd be in good hands with, but there can only be so many panelists. I should also say that we do have co-investments, and we are clients of some or more of them. So as both a banking client and a borrower. So there is a relationship there. There's a relationship there for a good reason. And like I said, please, the reason there's 3 here rather than 1 is we endorse all 3 and we have a relationship with all 3. And they're one of many that I think. So Ira, yes, it is now time for and part of the opportunity here is what other options are there? Is SVB the end all be all of all things? And is that the right thing for the industry? I would think the last week would tell us it's not the right thing for the industry, and maybe they're not the end all be all. I have friends in relationships with SVB, so I feel for what they've gone through over this last week, truly. There was a question around, but go ahead.
This is Lou. I just wanted to add a neutral comment to what Ira said, because I'm sure all 3 of us would love to talk to you. But I would say this to all of the companies out there. There's a perception sometimes that if you're not a borrowing client, that you're not a valuable client to a bank. Wrong. That's not accurate. If you don't need to borrow money, banks still need deposits, clearly, to make loans. So you are a valuable client and you deserve to be listened to and treated well. So I just wanted to put that out there.
Appreciate that. So there is a question. So one, contact information, name, title, and email address is now in the chat. So feel free to grab that and reach out directly. There is a question, because when Silicon Valley Bank makes you a loan, one of the requirements, and this is not unique to SVB, you are required to make the deposits at the bank. It's a way in which they reinforce the relationship and frankly collateralize their loan, whether that's officially through deal docs or just the simple fact that the money's there. And that's very common in the industry. And the question asked by Anthony George here is, outside of either not taking their debt or refinancing with another bank, how do you avoid that, or how do you deal with that? My honest answer to you, Anthony, and I'll open it up to the panel, is I'm not sure you can. It is, at least in my experience in banking, that if they make the loan, they want the deposits. And although it's not a quid pro quo, it is an understood that, we don't want you borrowing from us and putting money in a different bank. And so then it just becomes a question of, well, if you borrowed 5 and you have 50, do you keep all 50 there? Or do you divide that a couple other banks? Some of those other reasons. But that is more of a traditional sort of perspective on banks. And maybe you guys are breaking the cycle here. Any of the three of you do that differently?
Yeah, I'm reading the question. Oh, go ahead, Elizabeth.
Oh, sure. Yeah, it's, I think this is going to be probably a new frontier in terms of how much cash is remained at a bank. I mean, from a bank's balance sheet, you have loans on one side and deposits on the other side, and that's what balances a bank's balance sheet, which is why they want you to keep deposits there. Certainly, you can ask for a carve out. Hey, let me allow X amount of dollars outside of the bank. That's perfectly fine. Banks do that all the time. So, Anthony, you could certainly ask that if you're in that situation for a carve out. And I think going forward, I'd be interested, Jim and Lou, what you guys think. But going forward, I'm not going to be surprised that this becomes a new standard of having so many months cash runway, or however you want to phrase it or quantify it, outside of one bank, despite the various, insured products that we just mentioned as well.
Yeah. I don't know about the covenants that could be triggered from this. That's an interesting concept. The one thing I was going to jump in at early on, just to respond to Anthony's question, if I'm reading it right, he's saying he's got a loan with SVB, but wants to move the treasury and the deposit away. If I'm reading that right, certainly any of the three banks here and others would be willing to take your deposits and set up treasury management services that way. I don't know what SVB's loan documents look like. I don't know how they're going to be treated and handled. I don't know if anybody really knows how that's going to play out in terms of the loans that are on the books of SVB. I just don't know if anybody knows that yet.
Yeah, the portfolio company that I've been talking to, they have a piece of venture debt. They're not in the position to pay it off until they refinance with another bank. The problem is the uncertainty right now is causing other banks to pause. So they're not sure if they can refinance it. They want to move some money away from SVB, but it would breach their covenants to do so. So they're kind of in this unusual situation where they almost have to remain a customer of theirs until they pay off the loan, which could take a decent amount of time. So, and until the banking returns and they can actually now go refinance with someone else. But all the uncertainty in the market, I think, is going to kind of make it harder to refinance away from SVB. So that's what their concern is right now.
Yeah, Anthony, my take on that is if they haven't already done this, I would encourage them to make a formal request to consent to move some or all of their deposits, and the challenge there would probably be more bandwidth than common sense. Common sense would tell you that really is something that SVB should do. And the other thing I was going to say is I agree with Elizabeth. It's I hope it's a short-term thing, but for a while the clause that all three of us have in our term sheets that says this is contingent on you moving your deposits and cash management to us and us being your primary operating bank may be softened a little bit for a time and have some carve outs.
Yeah, you could ask them, Anthony, to help that company. It's called a deposit account control agreement, or a DACA for short. So in which SVB and the other bank would sign an agreement that SVB could call that cash and have operating ownership of that account should the company default or they need repayment or whatever stipulations are with the loan. So effectively, SVB can have access to that cash for repayment. That may be an option.
Okay. Thank you.
Yeah, and I would encourage a complete review of the loan documents because there could be some out where if the bank that's lending the money goes out of business, you may have the ability to move those deposits. It may be contingent on a DACA agreement, like Elizabeth said. But I'd have an attorney look at those documents pretty closely, see what your options might be.
And then the last thing I'll say, which having done banking for a little bit, always beware the MAC clause. And the MAC clause is the material adverse condition. And that is a catch-all for the bank's worried about you. And the bank thinks now they don't want to be lending to you. And by the way, they have the right to change their mind by instituting a material adverse change or condition. So now I will tell you that's a fast way for a bank to lose and destroy their reputation if they do that willy-nilly. So I think I don't think I have that concern with any of the three banks on this line. I have had, you know, when a bank had a loan outstanding, we finally closed the round that took a year longer than it took. Money hit the account and the bank swept the account, paid off their loan. And then came back to us after the fact and said, yeah, it was a material adverse condition change. So that is certainly a term that you have to be wary of, but that's about picking a banking relationship, not about negotiating deal docs. And that's always been one of my talking points is, you know, it's more important to know who you're working with and their background, their history and their reputation than it is whatever they stick in a deal document. So. All right, so we have 3 minutes left. I do want to make this official and make sure that if there are additional questions that weren't asked that get answered, that each of you had an opportunity to make a connection with our panelists. And before I wind up, just to thank everybody. So any last question? I think we have time for one more. All right, well then I want to thank Elizabeth and Jim and Lou for spending their time with us on this Friday. Thank each of you for joining us on this St. Paddy's Day in a late afternoon on a Friday. And I wish you all a great weekend. And I hope that this was both helpful and informative. And I certainly learned a couple of things that I didn't know before. So thank you for listening to me and joining us here today and look forward to doing something similar soon.